welcome everyone to the second webinar of Dave. I had a pleasure to catch up with him just before the webinar regarding changes that we actually do, because his time is really, really valuable. I'm not going to say anything more. Sit back, enjoy the webinar, write down the questions. And Dave, as we say in Greek, I'm all ears.
Okay.
Stage is yours.
Thanks, Alex. Safe travels as well, as I noted. All right. Good evening, good morning, good afternoon, depending on where you're dialing in from in the world. Both myself, as well as on behalf of the Trading Pit, we're happy you're here today. Let me just get things kind of coordinated here. Share my screen first of all. And for those of you that are back from last week, we're going to basically be building upon what we spoke about last week. I'm basically going to kind of go back to some real basics here. However, I am going to provide some market analysis as well as some specific trades that I'm looking at, because I would like you to be able to follow along at home, watch the progress, and then when we do another webinar in a couple of weeks, which will build upon this one, we'll have a report card. You know, I either hit the mark, didn't hit the mark, or we're still waiting for the trade to develop. So again, my name is David Floyd. I'm with Aspen Trading Group. I have started to work with the Trading Pit over the last few months. I believe in what their process is in terms of the prop trading field. I think they're approaching it from a very practical and very professional manner, as opposed to just having arbitrary benchmarks. They're truly looking for folks that know how to trade and want to cultivate them and form a partnership with them over time. Where does Aspen Trading fit into that? Well, I've been a professional trader for a number of years, well over 25. I manage a fund that is based on the way that I trade, and I also provide research to my clients as well. So I'm here more from the perspective of offering the guidance or the support that many people might need as they're looking to take on a prop trading challenge. Let's face it, trading's hard. It's not formulaic as many people want it to be, although there is a formulaic approach. Ultimately, you've got to bridge the gap between your formulaic approach and success with a fair degree of experience and intuition, just like in any professional endeavor you do. And that's why I'm here. I believe that I can provide some very fundamental building blocks on these webinars to get you thinking about how to trade, certainly in the right context, in the proper way, help you avoid some of the pitfalls. And then also my hope is that you sign up for a prop trading challenge through the Trading Pit using the link that I'll provide you here. And if you do that, depending on the package you choose, you will also get you'll get access to some of the tools and services that I offer, which will aid you on that challenge. Those tools being access to my morning report, where I'm giving an overview of what I'm seeing in the markets, which is going to be very helpful in terms of providing specific price levels that are going to be instrumental for you making trades. I'm also going to be providing specific trading recommendations when those when those come on, when the market allows for it, as well as access to the support and resistance levels that I'll talk about as well today, which are unique to Aspen Trading, something that I developed over the last several years and have rolled out to a multiple of trading platforms over the last couple of years. So that being said, let's get into it. You should see my screen right now, and I do have a few slides that I want to share with you. And I'm titling this ongoing series is called Trading Objectively. And also number two, I want to make sure that if you have questions along the way, please type them in, because I will be happy to address them as we go along, or I'll address them at the end, whatever is going to be the most convenient, but don't hesitate to ask a question. So trading objectively, what do I mean by that? Well, I think most people come into the trading game and they're looking for a particular approach that is going to aid them in making good trades. And sadly, most people come to the trading arena with very subjective ways to trade, meaning they have an opinion. I think Apple is worth X. I think the S&Ps will be lower by year end. I think Y. I think any number of things. The problem with that is that that's your view. Now, you may end up being correct, but ultimately the only view that matters is what the market's doing. And a subjective view of what the market's doing is not going to help you when you're simply dealing with prices moving higher and lower throughout the trading day. You have to have a way to look at the market and get in sync with it, not try to forecast where it's going to go, although that is a part of it, but that's not the main part of it. So trading objectively is the overarching theme that we're going to be talking about through this series of webinars. And let me get over to my screen here so we can type away. There we go. So after today, here's what you're going to begin to understand. And again, I'm not going to say you have complete mastery of these topics, but you're going to start to learn them and start to scratch the surface and begin your journey. So first and foremost, let me just bring over my drawing tool here, is what type of a trader you are. Number two, once you know what type of a trader you are, and I'm going to explain those in just a moment, how do you define the trend as it relates to the type of trader you are? Proper trading tactics, that's the key thing. How do you find out where to enter and exit a trade? That's based on trading tactics, a process that you have in place that tells you when to get in and when to get out. Without that process, you're basically flipping a coin, and that usually does not work terribly well. And then kind of in conjunction with proper trading tactics, it's allowing you to be, again, here's that key word, objective entries and exits. My cursor back here, and there we go. Okay, so what type of a trader are you? I'm going to guess there's a whole myriad of trader types on this webinar, and I'm going to break them into three categories, and there may be a little bit of mixing between the two, and that's totally fine. I'm certainly a mix of two of the trading styles in here, but the way I see them is as follows. I see them as short term, medium term, and longer term. Again, how you define short term, I guess that's slightly open to interpretation, but there are some general guidelines. I normally associate short-term trading with either intraday day trading or trades that last a day or two, nothing beyond that. Medium term, several days, maybe a week or two. And then of course, longer term, you're looking at trades that could last weeks, if not months, maybe even years. But the key thing is, even if you identify, okay, I fall into, let's say, category 1 and category 2, which is kind of where I fall. I love to do a lot of short-term trading, but when it comes to, let's say, currency markets, I like to push it out to the medium term. I like trades that could last several days, maybe a week or two. Whereas on my day trades, it's usually in the S&P 500, maybe an individual stock here and there. So again, I straddle the fence between these two styles, so to speak, or these two categories. But the key thing is like, once you say, okay, that's where I want to focus. The next question you have to ask yourself, is that suited to your temperament? Some people aren't suited to short-term trading. They'd rather place a trade and kind of walk away and let the market do its thing and have faith in the analysis that they've done will ultimately play out. So the key thing is choose a category that suits your temperament. For me, I'm not the long-term investor guy. That just doesn't suit my temperament. I like to constantly be working my portfolio and finding new ideas and moving on them, acting on them. And then when that move exhausts itself, I get out, take my profits, maybe even take my loss if that's the case, and move on to the next idea. That suits me. So that's a key thing you have to do, because if you try to force yourself into one of these categories and it's not consistent with your temperament, it won't work. It will not work at all. So if you're a short-term trader, I can probably expand on this. If you're really, really doing day trading, you're probably looking at 1 and 5 minute charts. But if you're looking at short-term trades that last a day or two, you're probably looking at 15 and 60-minute charts. And you'll notice I'm looking at, and then if you go to medium term, you're looking at 60 and 240-minute charts. And then longer term, you're looking at daily and weekly charts. I think the key thing that I want to stress in here is that, lost my train of thought there. You'll notice that on each of these categories, I've noted two distinct time frames. And we won't get into this today because it's a little bit more of an advanced concept. But this is what I would call dual time frame analysis. Again, nothing that I invented. It's been around for a long time, but I find it to be really helpful because what you're doing is you're using the lower time frame as a way to execute the trade to kind of get your timing a little bit more precise. And then you're getting in sync or in harmony with the next time frame higher. Now you could say, well, why is the 60-minute the next time frame higher? Why wouldn't it be 20 or 30-minute or 60-minute? There's no wrong or right answer, but you have to go far enough away where you're looking at a slightly longer time frame to base the overall trend. Does that make sense? If everybody could just type in whether or not that hits the mark, because that's really key. I want you to understand that, because the premise of this is you need to be always looking at the market through at minimum 2 time frames, at minimum. And obviously, if you're a short-term trader, you're less concerned about what the daily chart's doing. Yeah, you might look for some key levels and whatnot, but what the trend is on the daily chart may or may not really be relevant if your trade's only going to last a day or two. But again, that gets into more of the advanced concepts. So moving on, let me just get my screens situated here so I'm not fumbling around here. Give me a moment. Okay, so let's move on here. And again, any questions that come up, please address them as we're going along here. Okay, so you've identified what type of a trader you are, and you're like, okay, I'm a short-term trader. And you turn around, you look at your screens, and you're like, now what? Now what am I going to do? Well, in my mind, the best way to start is to determine which way the price action is moving. Is it moving higher or lower? And then you're going to determine that based on the charts that the time frames that you look at, based on what type of a trader you are. And then you're going to get in sync with that particular time frame. I've seen way too many people over the years, especially newer traders, try to buy bottoms and sell tops. And I can tell you that statistically speaking, that is a proven way to go to the poorhouse. Not only is it logical, if you sit and think about it, you're trying to get in front of the trend as opposed to get in line with the trend. But if you look at the brokerage firm data of all of the European brokers out there, which are required by law to put their data there, you'll see that the fail rate of most traders ranges anywhere from 70 to 75%, maybe 65 to 75%, depending on the brokerage firm. If you take that a step further, and you're someone like me who's been in the industry a long time and knows some of the people at these brokerage firms, you can ask one other question. What was it? What were the 2 categories, or what were the main takeaways as to why those traders failed? And the answer is consistent time and time again. And it's because of 2 things. And you may want to make a note here. They don't let their winners run, and they don't add to losing positions. Now that's a little different than what I'm talking about in terms of buying lows and selling highs. And that's what you want to do, but I'm saying going short at a high and going long at a low. You want to go in harmony with the trend, and you don't want to add to losing positions, and you want to stay in that position as long as you can until the trend changes. Again, conceptually very easy, in theory, conceptually quite easy. In reality, very hard to do. But if you avoid adding to your losers and try your best to let your winners run, you're going to be ahead of the vast majority of the traders out there who flame out year in, year out, and that will never change. That is the human condition. So my number one piece of advice to you today, and then we're going to build upon that, is to always trade in the direction of the trend. And it always brings up the obvious question, well, how do you define the trend? Let me go back. Actually, I want to go back to what you want to know is this: are prices moving higher or lower? It's really that simple. Prices are moving upwards and to the right, you're in an uptrend. Downward and to the right, that's a downtrend. It's really that simple. Does that make sense to everybody? Move on to the next slide here. Oops. Just have to keep switching back and forth between the drawing tool. There we go. I've already touched upon this, but it's in the slide deck, so I'll hit upon it anyways. Do you know why most technical analysis falls short of your expectations? And my answer to that, and I think it is the right answer, is it's too subjective. We talked about this a little bit last week. So many indicators out there, and individual traders' approach to the market is all based on subjectivity. It's what they think they see. It's what they think will happen. None of that really matters, because unless the rest of the market agrees with you, you're going to be wrong. Now, sometimes it'll agree with you, and that's going to give you what I would call a false sense of why that trade worked, and you're going to repeat it again, and then inevitably that's not going to work. And it's not going to work more times than it does work. So what we have to do is we have to put ourselves into an objective state of mind. You got to start getting into the habit of determining, are we in a trending market, be it up or down, or are we in a non-trending market? Sad to say, most of the time, the market is non-trending. So we have to be cognizant of that and know that when the market's not trending, we're kind of at a disadvantage. We need prices to continually move up or to continually move lower in order to have a trend that we can maximize. So being able to quickly identify that, again, is going to give you your starting point and keep you out of trouble by not going against that. I know I'm stating the obvious here. This is an uptrend. Prices are moving upwards and to the right. Downtrend is when prices are moving downward and to the right. What you never want to do in this market is, oh, the market's gone up enough, I'm going to get short. Nope, wrong answer. Oh, the market's gone down too much. What do you mean too much? That's a subjective view of the market. How do you define too much? There's no way to define too much in the market because it's a perception. And unless you know what the market's perception is, you don't have the answer. So you never want to be trying to buy in a downtrend, and you don't want to be trying to short in an uptrend. Now, are there times when you can break those rules? Of course there are. However, that's a very advanced trading tactic and not one you should be doing initially out of the gate, because you're now dramatically lowering the odds of you succeeding. And then inevitably what ends up happening is you short into an uptrend, it goes against you, and what do? You want to add to it. You want to increase your average price, or if prices are moving lower, you buy it here and then it's down here. Like, I'm going to add to it, I'm going to lower my price. What was the number 2 reason people flame out as traders? They add to losing positions. Therefore, trading in the direction of the trend is automatically going to put you in a much better position to succeed as a trader. This all makes sense, I assume. When we get into live charts, it becomes a little bit more difficult, but nonetheless, these principles are critical to your success. So let's go back. I'm gonna step away from the slides for just a moment, and we're gonna go to some real-time examples, and then we'll come back to the slides in just a moment. So, you know what, maybe the S&Ps were pretty good example of an uptrend. So this is a 4-hour chart. So let's assume that you're a trader who's going to be in a trade that's going to last several days or several weeks. And you start looking at prices here. Well, for the last month or 3 weeks, prices have moved up and to the right. So we're clearly in an uptrend. When prices pull back, that might give you an opportunity to buy, given that the trend has been up, and this is probably just a pullback within the trend. Now, I'm doing this with the luxury of looking at this after the fact, but the point of the matter is that nowhere in here did you want to get short. Now, that doesn't mean that if you happen to get lucky and short here, prices did move lower. But again, you're reinforcing a bad habit. Please don't do that. What you want to be doing is looking to establish the trend up, looking to buy pullbacks within that trend, expecting that the trend will resume. Maybe you're a buyer here. Maybe you're going to be a buyer down in here. Maybe you were a buyer there. You're not a buyer here. You're not a buyer there. And you're certainly not a buyer here. You have to be patient. Now, you don't know that this is going to be a top. So if you did buy it here and prices never pulled back, you look like a genius. But again, you're reinforcing a bad habit. And that's the thing that I'm trying to get you to think differently about as you approach the trading business. So think of it as an ebb and a flow. You identify the trend up or down, and then you get in sync with the trend. Prices move up, they pull back a little bit, you're a buyer. I'm oversimplifying here, but on some level, I'm not really oversimplifying that much because that is what we're trying to do. And then there are going to be tools that we use to know that it's okay to be a buyer on this pullback. Case in point here in the S&Ps. We're clearly moving higher over the last several weeks, and we begin to pull back. And you might say to yourself, well, when do I buy? Where do I buy at? Do I buy them here? Do I buy them here? What if they go all the way down to here? Then you have to have some sense of what you're going to do. And that brings me to the next phase of the presentation. And again, please stop me if there's any questions. I'd love to answer them as we go along here. So we're going to go back to the slides here, and we're going to go to the next phase, which is support and resistance. If you have the ability, or your software has the ability to label in the key support and resistance levels, then you now know with a fair degree of certainty where prices are likely to find support. So if you can mentally remember what the S&P chart looked like, prices were coming up, and then they started to pull back. Well, this is a support level. This line, again, this is obviously an example here. This is an example where prices have pulled back to support. The trend has been up. Now there's a pullback. When you get to a support level, again, oversimplifying, but again, I'm giving you the steps, the stepping stones to making a trade. Identify the trend, look for the pullback into a support level, buy that, expecting that the trend then resumes. That's a great entry. Do you buy it here? Nope, because there's nothing to lean on. There's no support level there. You wait for prices to come to an area that you have determined represents a support level. And you do that in a non-subjective way. You do that in an objective way. And that's what the support and resistance levels do. They're providing you a framework as to this is where the market is likely to find support based on historical price action. Not my interpretation, not your interpretation, the market's interpretation, which is all we care about, because the market's always right. Always. We're never telling the market what to do. It's always the other way around. Now, I'm going to share one other tool with you that you can also then use to help you with this. So you've got that support level. That's an area that you might want to get long at. Then you've got oscillators, which are measurements of overbought and oversold markets. The general premise, as you are all likely aware, is that when price action has moved higher, the oscillator will get into an overbought level. When prices have moved lower, the oscillator will get into an oversold level. Now, the key thing that you don't want to do is just every time something is overbought or oversold does not mean there's a trade. This, to me, is like the third piece to my analysis process, and it's a distant third. It's a nice confirmation signal, but it is not the primary signal. So let's go back to the chart I was just showing you of the S&P 500 with the support level, with the trend higher. Whoops. Where are we here? There. Oh, we're on oscillators. Let's go back to that chart I was just telling you about. Trend is up. Starting to pull back. We come into a support level, which is identified as 41.78. That level has been here, not drawn in after the fact. What do you have at the same time that prices have pulled back? We have the trend up, they've pulled back into support, and the oscillator is in an oversold position. So you got all three check marks: uptrend, pull back to support, oversold oscillator. Very simple, very effective. Does that constitute a long entry? The answer is sure, absolutely. We can never know for certain if a trade's going to work. Sometimes this particular setup may not work, but you have to take the trades that meet your criteria, put a proper stop loss in place, and then let the trade go. In this instance, you get long down around 41.78 and prices rallied all the way up to 4,300. 122 point rally in the S&Ps. I'm not saying you catch the whole move. That's not the point. The point is to show you, how do you identify a trade? You walk in one day and you're looking at your chart and you're like, I have no idea what to do here. Well, I just told you what to do with three very simple parameters. Identify the trend, identify a pullback into support, and does the oscillator support that? If all three of those boxes get checked, place the trade. It's as simple as that. Yes, there's going to be finer points that you're going to have to learn over time. But by doing that and saying to yourself, well, I don't have boxes 2 and 3 checked, okay, then you're not a buyer. There's no trade. And if prices move higher anyways, you're like, that's okay. It didn't meet my criteria. That's the key thing that we have to do. The only thing in here that is somewhat subjective is the oscillator. Yes, it's oversold, but you'll see many instances where oversold can become more oversold, like right back in here. Yes, prices are oversold, they bounce a little bit, but then prices just continue to go lower. Oscillator never really fully rebounds. So we can't know if that's going to be a low, but we can have a pretty good sense that this is a low here because we're hitting a support level in the marketplace that we've known about, the market knows about. Therefore, the odds of this being an oversold indication is a pretty darn good one. I can give you a few other examples here, and then we'll move on to some Q&A, and as well as, you know, what else I'm seeing in the market. Here's a great example. This is Treasury notes. Treasury notes are like, they're bearish. We are short Treasury notes for clients and in my fund. And I'm looking at a support level here. The trend, yes, the trend overall is down, but the immediate trend, and that's what I'm looking at in terms of this particular trade, the immediate trend's up. And we're pulling back, and we're potentially going to find support at this red support level, this Aspen trading support level at 112.27, 112.28. Oscillator is not oversold here, but what I would point out to you here, and this is definitely a potential trading opportunity for you, so pay attention here. We're making a new low, not a new low, but a low in this particular pullback, but the oscillator is not. That's what you call a divergence. Now, it doesn't mean that ultimately this oscillator doesn't get oversold and then turn higher, but as of right now, you'd expect the oscillator to be lower as prices are lower. So this is what they call a divergence. So am I ready to be a buyer of Treasury notes just yet? No, I'm not ready to cover my short and go long. But I do know that when prices get down to 112.27, I'll be looking to take some profits. And if prices start to hold 112.27, oscillators oversold, and we begin to move higher, I'm going to be on the lookout then for a long setup. So this is something you can look at for over the next week or two, no, next several days, week or two, This is how I see prices setting up in 10-year note. I'm sorry, not 10-year. Yeah, 10-year notes. Let's move on to the euro. There's also a nice setup in the euro as well. So again, let me ask a question. You're a medium-term trader, meaning that your time frame is out, several days to several weeks. Can you please tell me what the trend currently is in the euro? And if you could type in your answer, I would greatly appreciate that. Rick's got sideways consolidation. Anybody else want to venture a guess? I think Rick's onto something here in terms of sideways consolidation, but I'm talking in terms of the trend itself, because this could just be a sideways consolidation within a downtrend. Now, because I look at this, at least at first blush, to me, and I'm not saying Rick is wrong by any stretch, but the simple answer is the trend is down. This phase here where prices are rallied and come back down could be just this, a correction within the downtrend. That could be right. We don't know yet. I think where Rick's coming from, because Rick's a client of mine, so he understands a lot more of what's going on in this chart than perhaps you do, because Rick also knows that this 106.75 level is a support level. And there's some other factors going on here that suggest, and we're emphasize the word suggest, that we might be we might be in the process of turning higher. And I'm going to show you another chart in a moment that illustrates this. So Rick's answer of sideways consolidation might be correct in the context of that maybe the market's about to turn higher. We don't know that yet. For right now, the simple answer is the trend is down. We're holding support. We broke below it, came back above it, came back and tested it and held. That to me is pretty darn bullish. And I'm pretty sure that's what Rick's thinking too. That's pretty damn bullish. We can get what I call escape velocity. And let me get out of this drawing right now. And we can push above 107.43, which is the next green level, which in this case is resistance. We get above here, then I think we got open road. We go to 107.71, then all the way up to 108.38. This is a long trade that I am looking to make at this point in time. Yes, the trend is lower, and this might be more of an advanced trade for sure, but this is how I'm viewing it. So trend is down, but we're sitting on a big support level. We're starting to consolidate sideways. And then if you look at the dollar index, this just adds a little bit of fuel to what I'm talking about. The dollar index, meanwhile, is obviously the mirror image of the euro. Trend is clearly up. That's a horrible up arrow. It's too wavy. And we're pulling back. Notice where we held support, right at a support and resistance level. If you have that level on your chart, that's a huge heads up. Huge heads up. That's objective analysis, not subjective. And we started to rally up, but look at where we're getting stuck again, right at a resistance level, 104.32, another SR level. My guess, and I hate to use the word guess, but I'm thinking that we roll over. And if we roll over, that means euro goes higher. That's what I'm looking at in terms of the euro. I think the dollar index moves lower, and it may not. If prices go back above 104.23, I'm not interested in getting long the euro anymore. Maybe I go short the euro because then maybe we're reestablishing the uptrend in the dollar index here. Because certainly that hold here at 103.36 was pretty darn sweet. So that's where we are in terms of current markets. Yes, I keep a fairly narrow focus in terms of my markets that I trade. So right now I'm keen on euro getting long. I'm keen on covering my short and 10-year notes and then possibly getting long. Now, if we go back to the S&Ps in terms of where I see that market going, because that's pretty key in here. S&Ps are having their first day where everybody's God-given right for the market to go up every day is being put to the question, or it's being questioned. Imagine that, the audacity of these people to take the market lower. Frankly, as a side note, I think this S&P market's absurd, but that's just neither here nor there. I think our near-term target here is 42.40 because that is the next logical support level. So I would be looking at prices heading towards 42.40 in the hours and days to come. So maybe you want to drop your time frame a little bit, sell the rallies, expecting prices to move to 42.40. That's how I see things unfolding. So I'm going to go back to the slide deck real quick and wrap up this presentation and go to any questions that you folks may have. I do want to tell you though about this. We have a special going on through the Trading Pit, 20% offer on any of their prop account challenges. Starts today, June 7th, and ends on June 11th. You can take 20% off with this particular voucher code. So that's pretty key. Give me 1 second here. I'm going to just stop my screen share for just a moment. Hold on a second. Go back to screen share here in just a moment. Everybody can see my screen again?
Yep.
Fantastic. So what I want to also let you know, just give me a moment here. I'm going to pop this right into the chat room. So many windows open. There we go. If you use this URL to sign up for your right here, I just typed that. If you use that URL, you get a bonus. Not only are you getting 20% off the challenge itself, but oops, where to go? There it is. You're going to get 60 days of access to Aspen Trading Group, i.e. me. And it's what I alluded to at the beginning of the webinar, where Aspen Trading fits into working and partnering with the Trading Pit. I see myself and my firm as a guide, as a support for you as you go through these challenges. Challenges, i.e. trading, are challenging, not to be overly redundant, but trading's hard. Most people need support. They need guidance. And that's what we're offering at Aspen Trading. I'm offering you 60 days of access at no cost, provided you do the challenge. There's 2 challenges you have to do. It's either the executive or the VIP challenge. If you do either of those 2 challenges, you'll get 60 days of access to the morning report, which is basically a PDF file that comes out where I'm talking about what I see possibly happening in the markets, key levels to look for, basically trade scenarios. So your guide to the day ahead. You're also going to get new trade alerts. When I issue a new trade, you'll know exactly what to do. Entry point, exit point, stop loss point, as well as managing that trade once we get filled, because sometimes we'll adjust our stop losses, take partial profits, all the stuff you need to get out of the trade successfully. And then, of course, these Aspen support and resistance levels that you've seen in the presentation today, you'll get access to those for your Motive Wave or your TradingView platform. Those are the 2 platforms that are available on, and you can use them for any symbol. So I think having the Aspen SRs is key, because let's say you want to trade Tesla on any given day, or NVIDIA, whatever it is, those levels will automatically be drawn onto your chart, and you don't have to worry about fussing with the analysis. Those are the levels. Those will be the levels that the market will pay attention to and respect, and offer you kind of a heads up on where a trade might be setting up from. So that's all I have for today. I strongly encourage you to get in on the challenge. Oh, and also you'll get access to the Discord trading room that we have. So you can kind of be in a real-time environment where people are talking about the market, how they're identifying trades. It's a great way to really enhance your learning curve. So that's all I've got for today. Alex, I don't know if you're still on board. I know you needed to catch a flight, but unless there's any last-minute questions, that's what we have for today. And I greatly appreciate not only the trading pit, but everybody else showing up for the presentation. And I really do look forward to seeing some of you join the trading pit. And by doing so, you're going to not inadvertently, but also simultaneously join myself as well as the rest of Aspen Trading Group on your journey through your trading challenge. Alex, I'll turn it over to you if you're still there.
I am here, Dave. It was a great webinar, even though it's quite loud where I am right now. I really enjoyed the webinar. I did let my email address on the chat, so if everybody has a question, more than welcome to let us know. Again, one more time, thank you for your valuable time. Thank you for that input. As we both, Aspen Trading and the Trading Pit, we have a common characteristic of setting the love for the education. So thank you for your time, Dave. It was lovely being here with you and with the rest of the guys. Have a good rest of the day. Good morning, good evening, good night, to cover all time zones.
Have a good one, everybody. Bye-bye now.
Bye, everyone. Bye.